Hey everyone, Rob here from Phantom Trading, and welcome to the risk management section of the course. In this video, we'll be going over all of the content that we're going to cover in the following videos, and I also want to take this as an opportunity to introduce myself to those of you who maybe don't know who I am. Now, if you're active in Discord, you probably know me through the live backtesting sessions that we do through Zoom every other week, but if you don't, my name's Rob, obviously, and a little bit about myself. I've been with Phantom pretty much since day one, and I've been trading now for about 4 or 5 years. Now, I don't consider myself an expert by any means, but the one thing I do feel very confident in teaching is risk management. Why? Because I've kind of gone through it and made the mistakes myself. So I wanted to create this video series to actually help teach you guys, a little bit about risk management and how it works, the mechanics behind it, the psychology behind it, all of that, so that you can avoid making the same honestly stupid mistakes that I've made in the past. Now, the thing that I've noticed with Phantom, because I've actually been, I actually started out trading commodities, specifically oil and natural gas. I started with trading, retail strategies. Eventually, I made the switch to Forex, and again, haven't looked back from that. But when I switched to Forex, that's really where I learned proper risk management, right? Because you have to do things like using a lot size calculator. I mean, you don't have to. I mean, you can use fixed lot sizes, right? But I think for the most part, when people start trading the Forex, they kind of understand, okay, you want to risk X amount of percent of your account, right? Rather than an arbitrary lot size, right? So I've noticed with people in Phantom, for the most part, it seems like you guys actually use trade calculators and that kind of thing. But, whether you're doing that or not, whether you're a beginner trader or an advanced one, I still think anybody can pull some value out of these next few lessons, because I'm going to go very deep into how risk management systems work and how you can sort of pick a system that fits and is tailored to the way that you trade. So moving on, I wanted to give you guys an example of my actual track record here and just show you an example of what good risk management looks like. Now, I actually had a pretty low strike rate. I mean, it's all relative, obviously, at the end of the day, but I had a 25% strike rate across a sample size of 60 trades here. As you can see, I was able to pull a positive expectancy despite that low strike rate, right? That relatively low strike rate. And so, why am I showing you this? It's not to brag or whatever. I know there's a lot of you guys in the community that can probably trade better than I can even, and are able to pull positive R. And, I'm proud of you guys for doing that. It's great to see that. But for me, with the way that I trade, I take a lot of losses. It's fine, but I usually make up for it in big wins, right? So this is just one type of risk management system that can work, right? But it's to show you that, even though I hit losing streaks and stuff, I stuck to my risk management plan. I didn't go around fiddling with my risk and, consequently having, I didn't cause myself to have an equity curve that's kind of all over the place, right? Number one, I wasn't, going in over trading. That's another thing that we'll talk about too. But I didn't play with my risk in the sense that I wasn't increasing it to try and recover from, big losing streaks and then going into deeper losing streaks. Because remember, we can't know what's going to happen from a trade to trade basis, right? I don't know if the next trade is going to, be 24R or -1, right? So if I go around, maybe I'm down 4% and I decide, okay, I'm going to start risking 2% to try and recover from this, right? Oh, it's 2 trades. I have to make 1R each. Big deal, right? No, that's not the way that you want to approach it, because who knows if I'm going to lose the next 2 trades and then go down into a 6 and then an 8% drawdown, right? Because I'm now risking 2% per trade. And conversely, I'm not going around risking, 0.5 or 0.1% and, struggling on my winners to recover that drawdown, right? And so why am I bringing all this stuff up? Again, it's all stuff that I've done before. These are mistakes that I've made that I want you guys honestly to avoid doing, because it's honestly just going to hamper or dampen your ability to make progress in your trading, right? This is one thing, risk management, where you really want to have it solidified early on. It is a skill that's built up, right? Especially the psychological side of it. But, in the long run, we want to have our risk management sorted out so we're not running into these issues, right? And that way we can really focus on our technical analysis and our overall trading psychology, right? So I just want to show you guys my P&L calendar here for October, which would have been the first half of that equity curve that I just showed. And the reason I want to show you guys this is because, look, I even hit some pretty big losing streaks of 5 losses in a row a couple times over the month and I was still able to pull a positive expectancy because again, my winners like made up for it, right? Even though like, you know, I lost at the end of the month too, like it didn't really bother me. I went from basically 40R to essentially, you know, 34R. It's still a great month, right? All right, so let's quickly cover all the stuff that we're gonna go over in the following videos. In the intro to risk management video, we're going to mainly be going over the different types of lot size calculators that are out there on the market today. There's a ton of great options, whether you want to pay for something or you want a free version that's like an EA. There are options that are out there for MT4, MT5, and even CTrader. There's even ones that kind of compared with a hardware piece, so you can actually click on a button. It's obviously paid, right? But we'll go over all the different types. I've used both free and paid solutions for that kind of thing. And we'll also talk about why you shouldn't be risking more than 1% per trade, why you should be treating your sim trading and demo trading like a live account, right? We don't want to go into trading our demo or sim just like taking any random trade, right? We want to build good habits early on, especially if you're new, and treat it like they're live funds, right? That's very important to do. And if you're unable to do that, honestly, I suggest taking a small live account, something that you can put some money into, you don't maybe care that much about, but it has to be enough money that you're risking per trade that you kind of feel it, and you're not going to take 30 trades in a row or blow the account, right, and not care about it, right? So that's very important. We'll also talk about the minimum risk to reward ratio in a trading system and how to pick a balanced system. In the next video, we'll then talk about why you should be using fixed risk percent versus lot sizes. Again, it's pretty self-explanatory, but I still think there's a lot of stuff that you guys can learn from this. Whether you're an advanced trader or you think you have good risk management, you might even have good risk management, but it's good to understand some of these things about how fixed percent risk can compound your account and how it also helps to somewhat scale down risk in your account too when you're hitting drawdown, right? And we'll talk about why you should be using a fixed percent risk per trade on your account, right? Because listen, I'm guilty of doing this too. I've been in situations where I've hit drawdowns and then I think, I know what's going to happen on the next trade. I'm probably going to win it, right? Oh, I was wrong. And what did I do? I scaled my risk up to like double or quadruple what my fixed percent risk was, right? You guys know I normally risk 0.5% per trade, but I've been in situations where I'm like, okay, I'm going to recover from this drawdown. Let's scale up to 1 or 2%. Next thing you know, I'm taking losses with a huge risk per trade. And even on the flip side, I've also done the opposite where I've hit drawdowns and then I then start risking 0.1% and I catch some like 20R trades, and it's like, oh man, over that series of trades at the end of the month, I ended up having actually like a positive expectancy. But the problem was because I scaled my risk down so much, I wasn't actually able to recover much, right? A 20R trade with a 0.1% risk now becomes only 2%, right? So that small positive expectancy could have been, quite a lot higher, right? And if you were in a case where you were in a drawdown from the start and you went even deeper into drawdown or whatever, and you did the same thing, it could literally change what would have otherwise been a positive month into a negative one because you scaled your risk down so much, right? So there's a reason why we keep our risk per trade consistent. Then on the next video, we'll talk about trading systems. This is probably going to be the most interesting video because I've actually put together a ton of different account equity curve simulations. I've taken screenshots of it. So we have some actual data to back the different types of systems. You can kind of assess some of the more common systems that you guys are probably going to be using. Again, this is not anything to do with our actual like trading system itself. It has nothing to do with technical analysis, really. It's more so kind of what we can expect to pull in terms of our on average and what our win rate is over a long series of trades, right? So for every simulation, I think I did like on average 100 trades just to really have some like good statistical or good reliability in our data, right? If we have like a small sample size of 10 trades, obviously like 10 trades doesn't really mean much. If we then have 100 trades and we let the probabilities play out, we can more easily rely on that data set, right? Because we have enough data to back it. It's more statistically significant, right? We'll talk about the different types of systems and why extreme systems can be counterproductive, and we'll talk a little bit about trade frequency and exposure to risk, that kind of thing. And then last but not least, we'll talk very briefly about the psychology of risk management. Actually, it's not even going to be briefly. This is probably going to be one of the longer videos in this section. But this more so relates to, again, risk management. We're not talking so much about the technical side of things, but we will touch upon some of those facets of trading. But we're mainly going to cover things like account durability, the psychology of drawdowns, how to handle losing streaks, and how to build a proper trading psychology with that. And on top of that, we'll also talk about impulsiveness, over trading, and even being too conservative, right? Now, a little caveat to that. With being too conservative, I don't think there's anything wrong with being a conservative trader. There are team members on Phantom that I trade with pretty closely that I know they're very conservative traders, but they're conservative in the right way, right? When I'm talking about being too conservative, I'm talking more so about being fearful to enter trades that fit within your trade plan, right? Ones that you should be taking, trade setups that you should be executing on. If you're being overly conservative and not taking those trades, like that's definitely an issue, right? We don't want to be fearful or have like these emotions while we're trading, right? Trading should be really like a stress-free experience. You should trust in yourself. A lot of it comes with time and experience, but it's stuff that I think you guys should be aware of early on, even if you're new. Whether you're new or advanced, it's stuff that you should be aware of, period. We'll talk about revenge trading, how to stop doing it. I'm guilty of doing it. I found a rule that really helped to mitigate that problem that I had, very drastically improve my trading. We'll talk about how to find consistency in your trading. Obviously, consistency in your trading from a technical standpoint is very important, but so is consistency in your risk management, right? Remember, risk management is honestly number one. It's your number one rule. If you don't have risk management, you will blow accounts. Whether it's going to happen today or tomorrow, a year from now, if you're playing around with your risk, we're not Wall Street bets, guys. Like, we're not Redditors. We're not, YOLOing our entire life savings on 10x leverage position in the options market, right? This is not the type of trader we want to be, right? As much as some of these people out there maybe are making a fortune, there are a ton of people that also lose their shirts over it, right? It's a serious thing. So you don't want to approach Forex like that. And listen, I'm not saying any of you guys are doing that. I actually think Phantom in general has pretty good risk management from what I've seen in the community. Definitely every team member I know has good risk management. Nobody's playing around like that. But it has to be said, right? I think there's a lot of hype surrounding things like stocks and cryptos and stuff like that. You just gotta be careful of it, right? Understand the inherent risk behind a lot of these things, right? Forex is a little different. I think it's better. We're kind of more forced to calculate our risk. And if you're not, again, I hope I can convince you guys to start taking your risk management a little bit more seriously. Because again, it's going to help you in the long run, right? We want you guys to build an equity curve that's stable and something that's able to attract funding, whether you're going for prop firm funding or in the future you want to secure private funding. It's important you have these things set up, right? No investor is going to want to invest in somebody that is all over the place with their risk management and has a high chance of going into a deep drawdown that they're unable to recover from, right? Investors want to make money. You want to make money. Let's make money in a consistent way, right? We'll then talk about accepting risk, getting rid of ego, and how to approach your trading from a holistic standpoint and playing the long game, right? Again, very similar to the stuff that I just kind of covered. But anyways, I hope you guys are looking forward to the next few videos. Definitely looking forward to recording them. Should be fun, and enjoy.